Hey everybody, this is Slime here. I normally watch Trader Nick on my downtime, but I figure since I'm gonna start doing it on YouTube, it'll be better if you guys watch it with me. So without further ado, make sure you like, share, and subscribe.
Massive slide that we saw in the S&P 500 at the end of the day on Friday. And the reason for this is that Moody's cut America's pristine credit rating, citing rising debt. Kind of a sneaky little thing to happen at the end of the day after everyone kind of goes home for the trading day. Moody's puts out an announcement saying that the credit rating for the United States is being downgraded. Kind of a crazy thing to see that again in the after hours here. Stock market went from being, to its high to its low on the day, dropped about a 1% margin, which is not huge, but it is worth mentioning. You can see a pretty sharp drop here that occurred at the end of the day. That being said, when we take a look at indices and commodities in today's video, you'll see that last week was a pretty remarkable one. And in this video, what I'm going to be doing is sharing my insights, analysis, both fundamentally and technically, on markets that I'm watching, trade setups that we can look forward to in the week ahead, and market moving stuff that I think you should stay up to date on. Make sure to hit the thumbs up button and subscribe if you're new. Let's jump right into it. So starting out with the S&P 500 on a daily chart, we had a very constructive week following several very constructive weeks. In fact, the win streak keeps winning for the S&P 500. In fact, if we switch over to a weekly chart really quick, you can see that we've pretty much had 1, 2, 3, 4, 5, 6 weeks since we really bottomed out. So the 6 weeks overall, while we've had some red weeks in the meantime, for the most part have been driving higher for this market against all odds. People really counted the S&P 500 out, thinking that trade was going to send us, or trade relations were going to send us into a recession. And here we are, ladies and gentlemen, just under 4% from the all-time highs. So we went from, like I said, down massively here when we started this recent rally by 21+% on the S&P 500. We've bounced back 22.5% in just a few short weeks as trade relations seem to be drastically improving and looking more promising, and the Trump administration seems to have backed down a little bit in terms of their ultimatums that they were placing on the rest of the world in regards to trade. And the market's clearly cheering that. So as we look at the S&P 500, let's take a look under the hood at the technicals. So first and foremost, what we can see here is that we've had very constructive price action, putting in higher lows along the way, and continue to see bulls in full control. Sellers had the upper hand, if you will, as we continue to respect this downward trend line, but ever since we really saw the 90-day pause enactment here, we haven't ever gone back to retest those lows. People clearly cheering that optimism around, okay, if we give time to nations to negotiate, for countries to adapt, things could look a little bit more promising. That being said, I am bullish on the S&P 500. It is a current top setup here for me on the Edge Fund, or at least it was. Yeah, no, it is. S&P 500 getting a bullish +6 reading. And so that alongside, we also have the Dow Jones as a top setup and the NASDAQ. These are all bullish ratings on the Edge Finder. So when it comes to indices, my perspective here is I do think that they are still bullish, but they do look a little bit stretched in the meantime. So I'm personally looking for pullbacks if we can get them into a key area like the 5,700 to 5,500 level of support. Looking left on this chart, I do like these areas quite a bit for possible opportunities to add longs on a bigger picture standpoint. In the short term, I actually do think that we are looking a little overstretched to the upside. In fact, what I've personally done is I've sold some calls against some of my favorite stock positions, just because, again, I want to kind of basically hedge my bets a little bit. I think we're a little stretched to the upside, and I've had a really good year so far. In fact, here's a bit of an update on a personal performance note of my portfolio here. If we compare it to the benchmark, the S&P 500, which is year to date up about 1%, my portfolio is just shy of 12%. So I've had a pretty good year so far. It's not the most incredible returns you've ever seen, but I'm feeling very good about this. I went into this year cautious stocks and very long things like gold, which played a big role in my performance this year, you can see. So overall, it's been a really pretty good year, pretty constructive year for me. And I am still kind of positioned for a continued bounce back in equities. If we switch over here in the NASDAQ as well, I actually like this chart even more than the S&P 500 because I believe I have a pretty clear level of support that I'd like to get a trade on if I can, around that 20,400 level. Now, when we look at the S&P 500 and the NASDAQ, I want to just show you some sentiment that I thought was really interesting in the past week. We have shifted pretty dramatically from this area over here, which is what I would consider the extreme fear levels, right? So we had a ton of fear. Now, let me actually back up and just explain what we're looking at for the new viewers. By the way, welcome to the new viewers, and I hope you're doing great. Hope my channel is helping you so far. The put to call ratio is a really simple ratio indicator that shows the volume of puts relative to the volume of calls in the U.S. options market. And even if you don't trade the options market, this is super useful stuff because when we see a huge demand for puts like we saw in mid-April, what that tells you guys is it tells you, okay, everyone's scared and expecting the market to drop much, much further. And lo and behold, oftentimes when the crowd feels very strongly about something, the market has a great tendency to play gotcha on everyone. Now, the reason I bring this up is because now we are actually entering into a greed cycle, at least if we're going based off of the put to call ratio that we have in the Edge Finder. You can see over here for the first time this week, we actually entered into an extreme greed or high call demand region in terms of the put to call ratio. If you're a regular fan of the show or the channel, you really know all this already, and you know that I am a big fan of watching the put to call ratio. And so this was a good opportunity or an opportunity for me personally to put on some options trades and to sell calls against some of my stocks. Covered calls is what they're called, but basically capping some of my upside in exchange for making some profits if the market goes sideways or down. With that said, the put to call ratio to me is signaling that in the short term, we are looking a little stretched to the upside. That does not, however, mean that we can't go pump up and touch the all-time highs or even put a new all-time high. I'm not willing to bet against this market, but I am looking to only add to long positions if and only if we actually get some corrective pullbacks and see some of this sentiment cool off a little bit. So I'm watching levels, like I said, like 20,400 to 20,000 on the NASDAQ as a possible pullback play. In fact, if we add in some moving averages here, you can see some interesting things are starting to happen. The yellow moving average is your 200-day moving average. We gapped above and held above pretty much all week all of our major moving averages. And we're starting to see them all converge here back into the bullish direction. So I'll keep an eye on that in terms of moving averages, but I also want to just show you the Fibonacci retracement levels that we see when we actually draw in from this swing low here where we retested after that 90-day pause announcement up to this recent all-time high, or not all-time high, but this recent high that we see. And what we get very interesting is a 20,000 level confluence that is very strong. So to me, this is a high conviction area where I think bulls would likely step in to defend if we saw a little bit of weakness, perhaps off of this call that I mentioned earlier from Moody's downgrading U.S. Debt, basically saying that the national debt has risen dramatically. And the timing here is interesting, just in the midst of all this trade negotiations. But this is not a political channel, or that's not the purpose of the channel at all, but I do find that kind of peculiar. So anyways, when we take a look at this 38.2% retracement level on the NASDAQ, you have support in this area. I very much like the idea of potentially getting long on a pullback in the NASDAQ. And again, I think the path of least resistance here is to the upside. I think we are headed back to those all-time highs now that trade negotiations seem to be back on track and not so dire as they were over here. So with that said, again, part of the reason I showed you this earlier, but part of the reason my performance this year has done pretty strongly is because during the big sell-off that we saw in NASDAQ and stocks in general, it was an opportunity, in my view, for the long term to add to many of the stock names that I like for the longer term. That being said, let's move on now to gold. Taking a look at gold here, we had a very interesting week.
This is my shit right here.
And before I do continue on with gold, let me just mention really quick, if you guys are not already, I'm just doing this quick plug for the free Telegram channel. If you're not in the Telegram channel, we're sharing tons of free market analysis. I'm putting out some commentary throughout the week of just charts I'm finding. Like I mentioned, this put to call ratio thing I just got done discussing. If you're somebody who likes getting posts like this, if this would be beneficial to your Telegram feed or just to your day-to-day analysis, highly recommend you take a second. We just hit 40,000 viewers or subscribers on the Come back to this. So next up, we've got gold, and let's talk a little bit about this one because gold is a challenging one.
Discover a new way to trade with options on eToro. See what others are trading and copy their moves with.
If we actually draw a trend line here across this long-term trend that we've been in gold to the upside, what you notice pretty quick is you have, a very strong support around this area. And it's no surprise to me that we did get a bounce. We had a really straight shot to the downside, came into contact with this level of support. I think many traders expected a bounce at this level, and boy, did we get it. We got a very sharp move intraday to the upside, or an intraday reversal. When we zoom in here on gold's daily chart, you can see very clearly how this played out. We shot down to that support level, and buyers were ready. However, what is a bit concerning is the way that price reacted upon retesting this 3240 level of past resistance. I personally am I have a very cautious view on gold at this time. We put in a double top here. We broke the neckline. We're retesting resistance as we speak, and we've been in arguably a very stretched overbought state for a quite long time. Now, again, I don't say overbought as in, oh, this has to go down and it's too overvalued and it's got to come down. I just simply mean we are working off some of the extreme parabolic moves to the upside that we've seen, and I think we're in the process of correcting and pulling back. I don't necessarily think the uptrend for gold is dead, but some of the catalysts here for gold are no longer as compelling. Like, for example, the trade war, TW, right? All the concerns about US and China are just going to go into a no communication phase where they're just complete rivals and there's no... Well, we saw that kind of get squashed. They met in Geneva and they had a really constructive conversation. They both agreed to pause. They both brought their tariffs down, and they seem keen on, China wants to keep their biggest customer, and the US wants to keep those cheap goods coming to them. So there was some constructiveness there that I actually think takes away some of the use case of gold, which gold acts as a hedge to all this. People were buying it aggressively when those things were breaking down, and it only makes sense that people were selling gold when things started to look a little bit more promising between the US, China. So the other thing about this is that we saw some recent economic data here that suggests that the US economy is not falling off a cliff. So let's go here to our US economic heat map for a second and pull this up. So when we look at some of the U.S. economic data here recently, we see manufacturing PMIs, services PMIs. These are forward-looking indicators of the U.S. economy, and they both came in better than forecasts. The market forecasted certain values to come out. They came in better than expected. And not to mention, the non-farm payroll number actually came in much better than expected. We saw a nice uptick in job creation than what was expected in the market. So my point with showing you this is, while the U.S. dollar does not look incredibly strong based on the economic data, because of course we had some bearish stuff for the US dollar this week, like CPI and PPI coming in very soft. You can see May 13th and 15th respectively. We had some softening in inflation, which is bearish for the US dollar, suggesting that the Fed may cut rates. But we also saw retail sales better than expected. That's bullish for the dollar. And so when we're trying to analyze gold, we do want to, of course, keep a close eye on what's happening with the US dollar. And the state of the US economy, in my opinion, is not in disaster mode like people may have thought. And again, that is another reason why gold is losing some of its shine, if you will. So my concern here for gold is that the fundamentals have broken down a little bit. It played a role of security when everybody was panicking, but now that people are relaxing a little bit, I see gold still has room to pull back. In fact, the thing that I've been saying on my channel and in my Telegram channel, which again, make sure to join that, is I think we're still a good ways away from where we may actually find fair value, which is the 200-day moving average. By the way, from current levels, if we were to drop instantaneously to the 200-day moving average, that would be a 12.75% drop, or a $400+ move to the downside in gold. So I'm not necessarily short. I'm definitely not short. I'm not bearish, because technicals still look very strong on the bigger picture. But I do think that this is still a very corrective phase that we're in for gold. And I think will be ultimately healthy. I think this is a good thing to have, expectations reset a little bit for gold. And then there actually may be some great opportunities to get long gold on a longer term basis. So I'm watching very, hopefully actually, actually, for a longer term trade to the upside on gold. And again, moving averages are going to be interesting here. However, we are holding to the bulls' credit very well at this support level, this trend line level, and this moving average. I just don't love the fundamentals enough right now to join that trade. So let's check some other sentiment here. It's now time to take a look at institutional money. And just a quick note, if you're enjoying the video, make sure to thumbs up the video down below. It does let me know and YouTube know that you're liking this content and that you'd like to see more of this type of content. So what we're doing now is we're taking a look at the net positioning of institutional money. And you might say, what, Nick?
Shit, like finding a simplified version of this shit right here, the COT report, is so hard to find. And this is what I mainly watch this channel for.
Nick, that sounds a little too good to be true. Well, it is literally true, and it is a little too good to be true. I'll tell you more in just a second. The Commitment of Traders report shows us institutional positioning overall, and it is a little bit delayed. Essentially, we get Tuesday's data, as of Tuesday's data, on Friday. So as of Friday, right, May 16th, which was yesterday at the time of recording this, I'm filming this Saturday afternoon, we got the latest report from the CFTC's Commitment of Traders report. So that is actually telling us as of Tuesday of this week how they were positioned. So it is a little too good to be true. It's a little bit delayed, but it still gives us a very important macro, big picture, overall look at how institutions are playing this market. And so what we see here from a net positioning standpoint is we have things like the Japanese yen, very bullish by institutional traders, silver, gold, the South African rand, U.S. oil, the Dow Jones, the Nikkei, euro. All of these things are over 60% bullish in terms of their positioning. Like of all the traded contracts out there tracked on the CFTC's non-commercial positioning, most of them are long, right? So these are your bullish assets. On the bearish side, I'm talking 60% or more bearish. We'll count SPX, although it is technically under, barely. We'll call it SPX, the 10-year treasury bonds, the Australian dollar, right? The New Zealand dollar, the Swiss franc, and the Canadian dollar. These are your bearish assets on the list. However, don't get too excited here because I actually take the net positioning tool as a long-term indicator. This is not a very useful indicator for day traders and short-term swing traders. If you're holding for less than a few weeks, this is probably not a very useful tool to you. In fact, what you really want to pay attention to if you are anything less than a long-term position trader is this table here, the latest Commitment of Trader buy and sells. So this shows you in the latest week where they actually deployed money, where they sold, where they bought, etc. So let's go through some of our biggest buys on the week. And you can see this is the change in long contracts here, the change in short contracts, and their overall long and short positioning on a percentage basis. We take a look at the Nikkei, which is the Japanese stock market. We saw some accumulation. We saw a decrease in shorts and increase in longs. The Swiss franc, we saw an increase in longs and increase
shorts
in
for
shorts.
gold.
Bit of a mixed report.
But they
South
still
African
have
rand,
longs
you
in
can
there
see
too.
we
They
saw
added
an
longs,
increase
but
in
they added
longs and
more
an
shorts
increase in
than
shorts,
longs.
but more longs than shorts. The Dow Jones, we saw an increase in longs and a decrease in shorts, making this one quite attractive to me from an institutional money perspective because we see, again, net accumulation here. This is pretty aggressive buying going on in the Dow Jones. The Canadian dollar also saw a huge increase in shorts, way more increase in shorts than longs. However, this is already very short biased, so this kind of didn't change on a percentage proportional basis too much on the week. Take a look at oil. So oil, they decreased short contracts and they also decreased long contracts. The overall positioning, however, still remains very confidently bullish on a longer term basis. The Japanese yen, they decreased long contracts and decreased short contracts, reducing overall exposure. However, what we see here is their positioning is still very net long on the Japanese yen. 10-year treasuries, huge decrease in shorts and a big increase in longs. Very interesting there. Bitcoin, see a big increase in longs and a decrease in shorts. Pretty net bullish. Take a look at the euro. We can see on the euro side of things, the currency saw a big increase in longs and an increase in shorts. The Kiwi dollar, bit of a mixed report here. The US dollar, we also see decrease in longs and decrease in shorts, kind of a wash there. And then if we take a look at some of our more extreme readings, the British pound, what we see here, big decrease in longs and some decrease in shorts as well. Gold, we see an increase in longs, but a more significant increase in shorts. So this is overall net bearish on the week. So we see institutional money selling gold. We just got done discussing gold pretty heavily, so interesting to note. And a look here at the Australian dollar, we see a decrease in longs and an increase in shorts, very bearish. And I thought this was interesting. So I'm talking about how I think gold, or how the stock market's starting to look a little overbought. It's interesting to see institutional money kind of feels the same way, with SPX seeing a significant increase in short positions and a decrease in longs. Net very bearish. Take a look at Russell. Russell, if we switch over to this one, we can see that the Russell had a big decrease in longs and an increase in shorts. NASDAQ, huge increase in shorts, very modest increase in longs. So the way we'd read this overall, right, is a high level view of what did they buy and what did they sell? Well, they sold out of indices pretty heavily. They also bought into some specific, more value-based indices like the Dow Jones. They also bought into oil. So in terms of a net positioning, right, this is how we read the COT report. I hope that was helpful to you. And like I said, if it was, make sure to hit the thumbs up button. It lets me know that you enjoy that sort of commentary. We'll push on here now. Also, before I do, let me just remind you, if you're interested in getting a trial of the Edge Finder, there is a link in the description down below to where you can try out our software, or if you would like to just purchase the drivers on our account, interested in using it. We broke the trend here to the downside, I would say. At least going from downtrend, clear and obvious downtrend, to at least a mixed, neutral kind of dynamic. So I'm watching this and I'm saying, okay, we've put in a low, we've put in some higher lows here, we're trying to grind higher. What I think bulls needed this week, however, they needed CPI.
Monday CRM has the best AI features in the game,
especially in sales.
hands down.
So for me, email
To come in hot. Really probably a bull, right, for the dollar. Because again, trade relations going well, some of the economic data's upbeat. Had we seen CPI tick up to 2.5%, right? Had we seen an uptick in inflation and things, deteriorating on that front and rate cuts are nowhere near, then I probably would have actually looked for upside on the dollar. But now I'm just very, very, very mixed on the US dollar and don't have a strong bias one way or the other. However, here's what the bulls and bears, in my opinion, need to pay attention to going into this week. Let's mark our key level of support. That is the previous low, around 98.5. If we take a look at our key level of resistance, bulls need to see a break through this level. So if you're a bull from a technical perspective, let's see if we can get this move in the coming week. So something like this would be very strong for the bulls, recapturing and taking back this level around 101.5. Any sort of pullbacks into that area from a technical perspective look like we'd drive higher up to that 104.5. That would give us quite a bit in terms of upside potential for the US dollar. On the bearish side, for those who are bearish for the US dollar, I think really we've seen some struggle here from bears to really take back this trend. The thing I think you would need if you're a dollar bear would be a failure at that 98.5 level, specifically something like this. If you see this move, the dollar bears are back in control, and likely this would suggest rate cuts are coming and, maybe some deterioration in trade dynamics. That is likely the story that would accompany a move like this. But again, with inflation coming in soft, I'm very mixed. I think my personal view is that this is the outcome for the dollar most likely going forward. I just don't have a strong read. I think you probably see sellers respect this area and buyers respect this area, right? So that's kind of my thought process on the dollar going into this week. However, we can get a little bit more niche and talk about specific currency pairs. In fact, if we go to the top setups page here, and I'm just going to remove neutrals, and what I'm going to do is categorize just major and minor currency pairs here for just a second. We can talk some of the more interesting currency pairs. So in terms of bearish setups, we actually have the Australian dollar against the US dollar. That is, interestingly, one of two currency pairs that actually favored dollars. We're going for so for time, we've been come on. Oh, Alan, I think it's going to take a passion about sees all.
Skipping most of this because we trade indices. You feel me? Everybody here, indice people.
multiple, XX. Wouldn't mind building out a basket, which essentially means, speaking of which, we'll move on from the Japanese yen, which is one of my most convicted shorts at this time. But let's take a look at things like Bitcoin and US oil. We'll do Bitcoin really quick. So this one's pretty easy. I love Bitcoin to the long side. I think risk on is here to stay. However, I think that we have some pullbacks to do, right? So if we get this move here, love Bitcoin under 100,000, around 94,000. I'm interested. I'm a buyer at those levels with small size because Bitcoin is super, super risky. But I do like the upside potential for Bitcoin and looking for a retest on some of these key levels. We can actually extend this zone out to this level. You can see this was a huge level of resistance, and I think it now actually could behave as support at that 38.2% retracement level. So I do like Bitcoin quite a bit. Let's also take a look at oil. This one is one of my, so this one I would actually say is one of my favorite setups at this moment. So of all the setups that I'm watching, oil is getting the check mark for me in almost every way except for price action. So let's break this down. For newer, viewers here, I break things down into 3 components. And if you're a regular, you could practically say this with me. You know where I'm going with all this. We have fundamental
seasonal
analysis that we consider on this channel, technical analysis, sentiment analysis. I'm willing to bet that 99% of the audience watching right now feels most comfortable with this category. And I'm not picking on anyone, but let me just tell you straight up, the retail trading community is obsessed and overvalues technical analysis to no end. But here's something to consider, and this is a truthful statement that I say frequently, and I'm not trying to hurt any feelings about this, but everyone on planet Earth when they first get into trading obsesses over technical analysis and kind of ignores sentiment and fundamental analysis. And here's the honest reason I think that is. The reason is because these two are way harder. This is easy. Everybody can pull up charts. Everybody has access to tradingview.com. Everybody can learn about support and resistance and MACDs and RSIs, and that stuff's easy. It really is. Now, easy does not mean useless. So I'm not an anti-technical analysis person. I'm very pro-technical analysis, but I think it has its place. It's not a stand on its own 2 feet. Everything is technical. It's all easy if you just watch charts. I'm personally not a fan of that. I think that's what the retail trader, in retail YouTube space wants you to believe. I personally don't think that that is the case. I think technicals are a useful tool for finding entries and exits and helping you to manage your risk. However, I think this stuff is way more useful because fundamental analysis, guess what this beautiful thing does? Understanding why markets are moving the way they are, why the wind is flowing east or it's flowing west or it's flowing north. It's like the wind in your sail if you're on an ocean, right? You get my analogy. It's the direction. It's why markets are moving higher or moving lower. What is Trump doing with tariffs that could cause oil to move a certain way? What is the economies of the world looking like, which could drive demand for oil or hurt drastically demand for oil? By understanding the fundamental analysis some component of what we're doing here, guess what? We start to unlock the why we would want to be long or short a particular market. And sentiment analysis is a beautiful thing too, because sentiment analysis, by tracking what the crowd is thinking and what institutions are doing, we can get a real good idea of the risk to reward of a particular asset. If everybody's bearish on oil, it actually presents a really good risk to reward if you get long at the right timing and if the why makes sense. What we try and do on this channel, and if you're enjoying this channel, just a quick reminder, consider subscribing and coming back and hanging out. This is free value I'm trying to put out every single day. Like we literally upload every single day. So subscribe, don't miss a thing. The other thing is by combining all 3 of these things, what I think we're doing on this channel is building a more comprehensive view of the market. And that is ultimately what we're trying to do here on this channel. So again, that's the idea. Now, I am also not going to lie. Part of the reason that this channel features a software product all the time is because this is something that's for sale, and I'll never lie to you about that. I build tools with my team here. for me to achieve what I do in the markets. Anyways, we've derailed here a little bit. Let's keep going. Let's talk about this oil trade that I'm so interested in right now. So oil's getting a very bullish reading. We saw Edgefinder confirmation that institutions are very long oil, and I think that's really interesting to pay close attention to, but also the economic data, also the technicals, also the sentiment. These things matter too. And so the overall score is a +9 for oil, getting a very bullish bias, and I like this very much. The trend seems to be, at least in the eyes of the Edgefinders, flipping bullish. I personally would like to see on a technical basis a breakout of this 64 level. So 64, if we get this move in the coming weeks.
This may be the last ad you ever see. Because with the free ad block extension from Capital,
I am a buyer of oil. In fact, I think that oil has potential to seriously rebound in the coming months. Now, at least that's my perspective at this time. Could that change? Sure. But the technicals, in my opinion, still look a little rough, right? So bears are still in control at some key levels. We've got this downward trend line to overcome. But if you get something like this breakout here, this would be, in my perspective, a very high risk to reward trade setup. Now, part of the reason for that is that if we take a look at the specifically our put to call ratio for oil, right? Let's switch over to our oil chart for a second. What we can see on the put to call ratio is that there's still very high bearish sentiment on oil. Now, what we've done is we've looked at the put to call ratio, but selected specifically US oil. And when we look at this, we see that the extreme fear level for this asset, high put demand, is still very prevalent. People are buying puts on oil at this time pretty aggressively as it's traded higher. So to me, that actually primes up a really good breakout risk to reward trade. That's just one of the reasons. What about that economy data that I mentioned? The economic data, why am I so interested in that? Well, if we take a look at U.S. oil's readings across the board, we could see PMI data coming in stronger than expected. Retail sales was better than expected. We had a good NFP report. There's support here for, in my view, continued demand for oil prices. And I don't think that this downward trend is going to last forever. I think that, yes, we've had a strong downward trend since 2022, since the invasion of Russia and Ukraine. But take a look at the rebound that we saw post-2020 when the Fed kind of started cutting rates aggressively and the economy seemed to hold up decently. Sure, we entered into inflation territory. We had to deal with that. But there was this stretch to the upside that I think may actually return to oil prices. I think 62, I think we're actually in a good bargain area for oil on a longer-term basis, and I'm looking for longer-term upside moves. I mean, if the economies of the world are going to do well, which is what I think they likely will do, the demand for oil remains strong in my perspective. So that's my take on oil, at least at this time, waiting for confirmations. So that is, most of what I wanted to look at, but let me also make sure we check out the DAX. So the DAX, the German DAX, broke to new highs here. What a remarkable, we're after incredible as well. And I'm about to also, interestingly, the FTSE UK 100 will have to coverage there down below. Something in it for you. If you use the broker bonus, specific brokers, any channel in the
Alrighty. Thank you for watching. That was his analysis for the week. It's pretty similar to mine's. If you guys want to, I'll go ahead and break down some charts on gold and US 30 and whatever else I decide to trade for this week. But other than that, make sure you like, share, and subscribe to the video. Thank you for watching.